Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the first webinar in our 2023 dental series titled Examining the Impact of Private Equity on Dental Practice Valuation. And we're excited to bring another year of interesting topics and encourage you to sign up for the other webinars in the series, and I'll have more info on those at the end. But now, before we get started, I just want to take a sec and say a few words about SVA and our history in the dental industry. Like many of you, we got to where we are by being independent, and our vision moving forward is to remain that way and continue serving the same clients we have since 1974. And a huge part of that client base over these last now almost 50 years has been dental practices. Our mindset is that when you're a practice owner or shareholder, you have to work with someone who's more than just an accountant or a tax preparer. You need someone who's a true advisor working collaboratively with you. So this webinar and others like it are just one small way in which we try to do that. As far as this webinar goes, please send in any questions you may have as we go, but we're going to save them till the end. If you're a client and you have a question, but it doesn't get answered, we'd encourage you to reach out to your SVA contact. If you're not a client and have questions, please reach out to me or John Armstrong in our BD group, and we'll make sure one of our subject matter experts gets those questions answered. So today we've got two of the most experienced people in our healthcare and dental practice to walk you through everything. First off, we have Matt Vanderloo, who's not just a principal, but is also SVA CEO. Matt's been with the firm for 24 years, and much of that time, if not all, has been working with dental practices. And we have James Emmerich, or JD, who's also a principal in our healthcare practice and works with practice owners and practice managers on efficiency and profitability strategies. All right, well, let's get this webinar series started. I'm going to kick it off to you, JD.
Thank you, Lee. And thank you, everybody, for joining us today. This is obviously a very, very hot topic in the dental industry. We've started to see private equity get involved, and we really wanted to give a nice high overview, really high level, not too much detail that we can cram into a 30-minute presentation, just to kind of give you an update on what we're seeing, where to go, and the overlay, and take it from there. So with that, we'll dive in. And before we get too far, we're going to start off with a quick poll question. And the poll question is going to be, what's your time horizon for selling your practice? You should have 4 options in front of you: less than a year, 1 to 3 years, 4 to 7 years, or more than 7 years. So if you could please take a minute, answer that, that'd be wonderful. And we'll share the results as soon as they're ready. All right, so you can see on the screen here, we got 1 to 3 years as the leader in the clubhouse, followed by 4 to 7. No votes for less than a year and no votes for more than 7. So we have some on the time horizon here. All right, next we're going to move forward. We're going to talk about the impact of private equity. We kind of highlighted some general thoughts on the screen here. First, private equity, very active in the dental industry. Okay. Obviously, that's true. That's why we're having this webinar. We're starting to see a lot of movement in the dental industry, but that's not the only place that they're getting involved, okay? We've seen them involved in medical practices. They're getting involved in veterinarian clinics, and they're also getting involved in the professional services world as well. So private equity is becoming a very big player, and it's something that we got to talk about. It's something we got to watch for, and we're going to continue to look at the model. General dentistry and specialties, there's very, very subtle differences between them, but they're out there. You know, depending on what your specialty is, you may get more. When we talk about the value and how they derive the value, cash available. So this really hammers home the point that private equity, when you think about it, a lot of money, right? So cash is going to be available. It's going to be upfront. It's going to be on hand, and you're going to get that cash in upfront. No seller financing. So traditionally or historically, in a typical model, when private equity is not involved, the deal structure can sometimes have the seller financing the deal, maybe an installment sale, and over time there's going to be payments that are paid out. This pretty much goes away under the private equity model. The money comes in right up front, and so you can kind of expect to get that payment right then and there. small bullet point rollover equity instead. Really what's going to happen is when you make that sale to private equity, you're going to get cash up front, absolutely. But you're also going to be taking on, or most of the deals are requiring the seller to take back some rollover equity in the private equity entity at the top level. So that's kind of another ticket. So they assign value to your practice. They're going to give you cash up front, and then you're going to get some equity in the PE. And you're hoping that PE at some point continues to grow and continues to double or triple in value. And when they sell, you get a portion on the exit. And then the last bullet point here, support higher valuations. Again, same thing. Private equity is going to come to the table, and they're going to end up paying more for the practice than a historical transaction would look. You know, if you're doing a sell agreement to an associate under this model, you're probably going to see more than you would traditionally when you're selling to private equity. Okay. Next, we're going to talk about the impact on practice values. So as we move here, you're going to see a couple different options or scenarios on the screen. So what's the value based on? The value is based on EBITDA, and that's a big buzzword right now, right? And that stands for earnings before interest, taxes, depreciation, and amortization. Okay. So they're coming through and they're going to do a calculation, and they're going to determine what your EBITDA is. And then they're going to pay you a multiple of EBITDA. And traditionally, or at least right now, what we're seeing is anywhere from 4 to 8 times EBITDA. So when they look at the EBITDA, they're going to take your financials, they're going to peruse them, they're going to go through it. And then the second spot here, normalized EBITDA. What that means is they're going to adjust your EBITDA to what they believe is real life EBITDA. You know, traditionally, you or your fellow colleagues own the practice. You guys are paying yourselves out the compensation. At the end of the year, you know, distributions, compensation, they look at all this and they adjust it and say, okay, we see what you paid yourself. What would it actually be if we had a replacement dentist in this practice? Let's figure that out. And so they do an adjusted or a normalized EBITDA calculation. Next, one thing you do have to consider in this whole conversation with private equity is the income scrape for owners. You know, they're going to pay you up front. They're going to give you a nice payday. And then they're going to require you to stick around for anywhere from 3 to 5 years. Historically, the transactions that we've seen have been a 5-year period after the sale. And you sell knowing that you're going to take a compensation hit. You're getting more money now. You're going to get less money later as you advance in your career and you continue to work for the private equity group. That decision or that determination on the income scrape that you're willing to accept, that's going to have impact on the value. Okay. So next, you know, we're talking about EBITDA. What really drives EBITDA and how can you impact it? Well, EBITDA is really going to be impacted by the change, the multiple you're going to get on EBITDA is going to be derived by the revenue and volume of the practice. How big are you? How big can you grow your practice? How big can you increase the top line? That's going to really drive what multiple you see. You know, you're maybe at the low end and you want to get higher to that 8. What are some things that you can start thinking about now to get you to 8? Number of locations, that's another important topic. They come in and they're looking at the whole size of the practice, not just one location. They want to see you as a group, number of locations, and again, specialty. What kind of specialty are you in, if any, and how does that impact the multiple? Everything is variable. They look at all this kind of stuff. So it's good that you start to think about this now if you're really going to consider moving to a PE model when it comes time to sell. Okay. Next, we have a quick poll question that we're going to talk about. Have you been approached by a PE firm or a DSO about being acquired? Very simple, yes or no. And again, this will be on the screen for about 30 seconds, and then we'll move forward and we're going to talk about how complex one of these deals can be. All right, so we're right about 50-50 here. Some of you have been approached, some of you have not. I would anticipate that as we continue to advance, I have a feeling that PE is going to come knocking on more doors. So I would not be surprised if very soon we're going to have more and more saying, yes, they've been approached by PE. Okay, we're going to move forward and we're going to talk about the deal structures and how complex they are. And these can be pretty complex. So it's very important that, we're doing a small, quick snapshot here for you, but these can be pretty detailed. So where I'd like to start is in the top, in the middle, there's a rectangle that says old practice, and there's a line that goes up to the Pentagon that says DDS. Okay, this is the traditional model. We have a practice that you're the owner of or operating out of, and then it's you or maybe some other partners that are owning the entity. And so traditionally, all the revenues, all the practice stuff goes under this old practice, and then the compensation flows to the docs. What happens under the private equity deal is if you move to the bottom right-hand corner, you'll see there's a new practice that gets formed, okay? And it starts with, the patients come in, the patient revenues come in, there may be new owners, but where it starts to really get complex then is that triangle in the middle of the screen. That's the new management company. So what PE does is they set up a management service company, and they get a management service agreement with the new practice, and they charge a fee. So the new practice, you're an employee, a W-2 employee out of the new practice, and you can see that squiggly line on the right side says compensation going back up to the docs. So you're getting paid to do production, you're doing your services, you get W-2 pay. The revenues that come into the new practice then are moving into this management company, okay? And this management company is then sending that money out to the holding company on the left there, that oval, that's the private equity. That's where they're making their money, okay? And then you can see in our model or this example, it says 80.5% are going to the holding company, and then 19.5% are going up to the old practice. So depending on how your deal is structured, you may or may not get some of that MSA, that management revenue. If you can, great, because that's really what we'd like to see. And then that money flows up to the old practice, and you're still an owner of the old practice. That old practice still exists. That money, some of that money will get funneled out over there. Okay, so again, very, very high overview. This looks like a very complex diagram, and that's because these structures are complex. Okay, most important thing you can do is you can get your team of advisors involved. You want to get your professional services team. You want to get your attorney involved, somebody who understands how all this works, make sure they can simplify it, walk you through the process and the model. And then of course you want to get your CPA involved, make sure that this deal is going to be fair and it's exactly what you want. Okay. Matt, anything you want to add regarding the complexity of this model?
No, not a ton. You're right. This example is an incredibly complex one. This is one that was pretty similar to one we had a client do. Depending on the PE company you work with, they're all going to look a little bit different. Not everybody uses that holding company between the PE entity and the new management company. The other thing to remember is that some of the PE companies will tell you that there's going to be some sort of cash distribution or dividend that comes out of that PE entity and goes back to the owners. That'll be another source of income. But that's not always the case. And even for the deals we've done, we haven't seen anybody see those dividends or distributions come out of the PE entities yet. I think the other really important thing to know about this is that usually that old practice that you have set up is still going to continue to exist as you go into the future. Typically that rollover equity you're taking back in the PE firm will get transferred into your old practice in exchange for the assets that are in that old practice. And that makes it a tax deferred transaction. So you don't have to pay any tax on the rollover equity you're getting in the deal. But to make that stay as a tax deferred transaction, the PE ownership has to stay in your old practice. If you distribute it out to the dentists who own that old practice, that'll be a taxable event, and everybody will suddenly have to pay tax on the value of that PE ownership when it comes out. We talked a little bit about, JD talked a little bit about the idea that in these structures where we're not seeing any seller financing per se anymore, that in that old model, old dentist selling practice to new dentist, the old dentist might play the role of bank for some of that transaction price and take back a promissory note to help the new dentist buy in and get paid off over time. There was an advantage there to the seller that they got to spread the tax burden out from that transaction as long as they were receiving payments. There's not going to be that note payable anymore from the new buyer to you as a seller. PE doesn't need to do that note. What you'll see instead of seller financing, though, is this rollover equity. You might get promised a really big number as a sales price for your practice. The majority of that, a big chunk of that, you're going to get in cash at closing. So there's a lot of cash that'll come your way at closing, but some of that price is going to be in the form of rollover equity. And that's really the new version of seller financing, is that instead of getting all the cash up front, some of that sales price is going to come as rollover equity that you're going to get a benefit for in the future, hopefully. It presents risks, just like that note payable from the buyer would present risks, but it's a different set of risks and a different set of considerations to think through. One thing that is also unique about these PE deals is that I have not yet seen a deal where the PE company has wanted to buy the real estate of the dentist. They don't want to own the practice space. They just want to own the practice. Different than transactions from one dentist to another. Usually if you're buying a practice, you also want to buy the office, the facility, and own that too. PE does not. So you're going to have the opportunity, if you want to keep that real estate and be able to collect rent from the PE firm. Some of the PE groups have relationships with third parties that will acquire the real estate if you don't want to be a landlord anymore and want to get rid of it. So there will be an opportunity potentially to sell depending on the group you go with, but it won't be the PE entity that's buying. So if you're thinking about going the PE route, or if you're in that process, one thing you want to make sure you do is make sure that your rent gets up to fair market value. So you've got that established, and the PE firm that's acquiring doesn't think they're going to get any discount from you on the rent when they take over the practice. In some practices, we see that we don't always have rent set at fair market value. Sometimes we set it more than fair market. Sometimes it hasn't kept up with fair market value on rent, but you want to get that up. And just know too that that change in rent is going to change your EBITDA. So it might change the value of the practice in terms of how the PE firm is going to look at that and value your practice when all said and done. There are lots of financial considerations to think about here. Remember, you're going to have that continued employment. Most commonly, we're seeing it at about 5 years that you're going to stick around for the PE firm and work for them. And there's going to be a compensation scrape that goes along with that. Whatever you were making as an owner, if you produce the same for the PE firm, you're going to make less. The PE firm is going to take some of that profit in the firm, some of the payroll maybe you were getting out, some of the distributions maybe you were getting out of that old practice, and it's going to be a management service fee that flows over to that management service organization, or it's going to be additional profit that gets left in that new entity to help fund the PE's acquisition. So it's not you're going to make less, it's how much you're going to make less, how much less you're going to make. And depending on how much less you're willing to take as compensation, that can impact the sales price of the practice, because as they go through that process of normalizing EBITDA, they're going to reduce your current compensation. And if you're willing to reduce it more, there's going to be should be a corresponding increase on the purchase price. And then you just need to look further out into the future, and project how much you'd make over the next 5 years if you own the practice versus how much you're going to make over the next 5 years as a new employee in this new entity. And also compare the sales prices under those different circumstances. If you sell right now to PE, what's your sales price? If you stick around for another 5 years and sell it to another dentist who can step in and take over right away, what's the sales price look in that situation? And compare the total cash flows from those two different situations. You also have the potential to get multiple income streams in this new ownership structure. You're going to get W-2 for the patient work you're doing in the new practice. You should get some share of the management fee coming over from that management service organization. There might be some income that's coming over from the PE entity. You can still be getting rent if you own the real estate and continue to own the real estate. So there's lots of different income streams to think about and to bring into the calculus as you're looking at these deals and evaluating them. And then, as I mentioned, remember that on that rollover equity, as long as it sticks in the right place in that old practice, you're not paying tax on that at the time of the transaction. You're paying tax at some point in the future when you either sell that rollover equity back to the PE firm, or when the PE firm sells, they'll call it recapitalizes. There might be an event there where you are able to get rid of your ownership and take value out for that. And at that point in time, when you get cash for that ownership entity or that ownership rollover equity, there will be a tax consequence at that moment. One of the stumbling blocks we've come across or issues we've talked about with a number of firms is PE valuations versus what your current internal valuation might be on the practice. in the last 10 years ago, we saw very, very little, if any, PE activity. 5 years ago, it was still relatively small, but now we're seeing a ton of it. And it's definitely out there in the marketplace. And it's at higher multiples and higher valuations than most people have in their internal documents. So if you've got a buy-sell agreement with your partners, a partnership agreement, a shareholder agreement might have a way to value the practice and buy someone out. And typically those methods and valuations are lower than what PE would come in at. So you really need to consider and think about those internal documents. They don't necessarily have to be updated if you and your partners are comfortable with what they say and you're all aligned on how you want to progress forward as a practice. They don't necessarily need to be updated, but you definitely need to consider it and talk about the different impacts. Should you adjust the buy-in or buyout prices in any of those documents to reflect what's going on in the marketplace because of PE? The other issue we've tried to work through with a number of practices and help them think through is how PE playing in the marketplace and a potential PE deal might impact bringing new owners into the practice, new practicing dentists who might be associates who want to be at the ownership level. What are we going to do if they buy in today at our current internal valuation, and then tomorrow we sell the practice to a PE firm? Are we going to let those new owners participate in all of that increase from our internal valuation to however PE might value our practice? Or do we want to vest those new owners into that full increase in value from our internal valuation to the PE valuation over a period of time? Even if we're bringing in a new owner today and have no intention of doing anything with PE right now, that might change in 3 months or 6 months or 2 years. And we need to think about how we'd want those new owners to be handled and treated in that situation if something changed. The other consideration you need to give, especially if you're starting to think about a deal with PE, is that rollover equity and how that might impact your new owners. If your practice sells to PE, PE is really going to want to have a tight hold on those newer, younger owners and is going to want to keep them in the practice and keep them producing in the practice because they need the practice to be busy to make the deal make sense. So they might try and incent those new owners, younger owners, to stick around by offering them more rollover equity, less cash when the deal consummates. If that's the case, though, that new owner might have other obligations related to their buy-in that are still on the table that they need to think about. If they still have a loan with a bank for their buy-in, that rollover equity is not going to help them much with the monthly payments they need to make to the bank to keep current on that. Or if it sells, what's also likely is that the bank might call that note and want all of it paid off, since they'd be in a secondary position to the PE firm. So how's a relatively new owner who still has a bank loan going to deal with that if all they get is rollover equity out of the deal and they're not getting any cash out of the deal? How can they make that all cash flow and work? So there's other considerations as you go through that planning process if you're starting to think about it that you need to take into account for those new owners, those younger owners in the practice. Our last poll question for the day here. Interested to know if you have a preference. Would you rather sell to an individual dentist? Would you rather sell to the private equity DSO model, or still undecided, still thinking about that? We'll give you a few seconds here to think about that and consider your options. So it looks like, some people still undecided, some people a little bit more interested in that private equity DSO model, but more than half, the majority of the people still interested in that sale to the individual dentist, which actually aligns pretty closely with what I'm seeing in my client base and what I see and hear as I talk to other dentists out there. I think most people are still interested in trying to find those other individual dentists, independent dentists, and giving them an opportunity to own a practice and grow in a practice. So it's great to see and great to hear.
That's great. Matt, I think you guys yes, I thought it was question time. So Matt and JD, awesome job. Lots of stuff to cover. I feel like you guys could have spent a full half an hour just on that complex structure page, because I definitely had questions coming out of that. We've had a couple of questions come in, but I would encourage any of you to please chat them in. We'll get to as many as we can here in the next few minutes. So let me just bring up the first one. Okay, so will it impact my practice's valuation if there are certain things I'm running through the business, or should I stop doing that before they look at it? I think getting at some of that, I forget what you called it exactly, JD, I think.
Yeah,
they were
so
looking at the EBITDA.
yeah, so the impact, they're going to go through and they're going to make adjustments, and they're going to find those things and they're going to carve them out. So whether or not you run them through or don't, and Matt, you might have a different opinion on this, but whether or not you run them through or not, they're going to come up with a normalization or an adjusted EBITDA based on what they see on the financial statements. So they will certainly review it and they will carve those things out and adjust those accordingly.
Yeah, I don't think it's as important to get all those expenses out of the practice prior to the deal. What would be most important is to be able to identify all of those, so that when the PE firm comes to you and sees your financial statements, you can give them the list of here's the personal stuff, or, you know, things like that that might be a little bit overstated that are going through the practice that the PE firm's not going to have to expend, so that they can normalize that out and increase your EBITDA to the appropriate level.
Okay, so we've had a couple questions come in that sort of touch on this. Let me just read this one off. What have you seen for compensation for dentists that stay on for a few years or more? Are there production minimums or production bonuses? Can you, I guess, just talk a little bit in general about what you've seen there?
The couple I've seen, the most recent ones I've seen, the compensation for the dentist staying on has been purely based on production. So they've got a percentage of net hands-on production, and the percentage amount used for that has varied based on how much of an income scrape they want to take and what they want normalized EBITDA to look like. Those are the ones I've seen. I know there have been other ones where they've set a base salary for a dentist, and then had production bonuses on top of that. But I haven't seen any. I personally haven't seen that structure as much recently.
Yeah, Matt, same, what you outlined in the first part there, production, hands-on production, and a percentage of it is what I've seen as well.
Another question that came in is, how can younger associates buy in without a bank loan?
There's two ways younger associates can buy in without a bank loan. If it's a single dentist practice and we've got a new single owner coming in, we can keep the bank out of it by having the selling owner play the role of bank and do all seller financing. Or if that new dentist who wants to buy in has saved up a bunch of cash at home, they can use that for their buy-in, so we can keep the bank out that way. The other way we can keep the bank out of a buy-in is if we're in a group setting. We can have the group, the practice essentially play the role of bank for that associate coming in. We might still need them to bring a small amount of cash to the table to, you know, show they're truly interested and have some risk online. But then in years 1 through 5 or 1 through 7, we can simply account for that buy-in by taking compensation that the new associates earned and reallocating it to the existing owners. We've got a number of models that work well to do that. If you're interested in that, we'd be happy to sit down and talk in more depth.
So I think we got time for one more question. I'm going to kind of, again, a couple of questions came in that touched on this. I'm going to put you guys on the spot. So the last poll question was around knowing all this, what would you prefer to sell to, an individual dentist or a PE or DSO? And I guess the question I have for you is, and what people have touched on is, what are you seeing for the difference in what those valuations are right now? And this is one I'll add in, what are you seeing from the marketplace as far as, I guess, where's the wind blowing as far as what you're seeing from your clients?
Yeah. You know, if I was a dentist who had a practice and I was looking to sell, I would definitely want to consider all my options. And I would want to do an in-depth analysis of that compensation scrape and that 5-year difference in comp. What does that look like compared to different sales prices if I was looking at a PE firm versus an independent dentist? Being an owner and an active person in a independent professional services firm who would like to see our firm stay independent and be around for another 50 years. I don't know if everybody sees these in my background. SVA is celebrating its 50th anniversary as a company this year, and I'd like SVA to exist 50 years from now. So to do that, I don't think PE's a way that I could exit a CPA firm and have it continue on. So part of me would be drawn towards selling it to other CPAs who could continue that legacy, but that's kind of a personal emotional preference. It doesn't really play into the dollars and cents. I think what we're seeing, I don't think we've seen it as much in dental yet, but I'm hearing rumblings in the financial world that the increase in interest rates and the ability, the lack of an ability to access cash at a low interest rate anymore is going to have effect that trickles through these PE deals. And multiples are going to have to come down in response to that. It's more expensive and it's harder for PE firms to get cash to do deals right now than it was 6 months ago, or even more so if you look a year ago and compare those interest rates. So that I don't think this is all written yet and it's not all settled. We're still in the dental space, relatively new into the PE activity and how it's all going to play out. The other piece, and I don't know what you've seen, JD, is I have not seen anybody who's sold to PE have that PE firm recapitalize yet. So I've got a lot of people who've sold to PE and own a bunch of rollover equity in the PE, but nobody's been able to completely turn that rollover equity into cash yet. And if you look at the proposals PE does, they're going to show you a pathway to taking rollover equity, and then 3 to 5 years after your deal, they're going to tell you there's going to be a new deal, and your PE is going to go from whatever number they made up when they gave it to you to a much bigger number that they're making up when they exit. Because the other thing to remember is when that rollover equity that they give you, that's not stock that's traded on a stock market. They've got some sort of internal method to put a value on it that should have some market realities to it, but it's not like there's a willing buyer out there who they're able to say we could sell it to that person for the same price. It's a made up internal number, and they'll show you a projection that has a made up internal number as an exit point. But so far, we haven't seen any of these dental practices reach that exit point and get that cash.
Wow. Okay. There you go. There's another half an hour webinar right there, I think, Matt. JD, Matt, awesome job. Great information. Great first webinar here. As we wrap up, I just want to point everybody towards sva.com/dental series to sign up for the other webinars in the series. You can also find news and information that may affect your practice. Our next webinar is on October 17th, and the topic is Drive Practice Growth with the top KPIs you need to track. I'd like to remind you all that the SVA team is only a phone call or email away. So if you're a client, reach out to your SVA professional as questions arise. If you're not currently an SVA client, contact me or anyone in our business development group so we can get you the help or the answers that you need. Thanks for attending today and hope you have a great rest of your day. Bye-bye.